What if the golden age of easy money is officially dead? The era where simply owning assets made you rich effortlessly is over. And most people are about to get blindsided by what's coming next for their money. For the past 15 years, we've been living in a financial wonderland, a sweet prince of cheap capital that supercharged nearly every investment. But now that prince is gone, vanished. And if you don't understand why and what's next, your financial future is at serious risk. Get ready, because the rules of the game have fundamentally changed. Think back to 2008. The world was crumbling, but central banks stepped in with a radical solution: quantitative easing and near-zero interest rates. This wasn't just a band-aid. It was a fire hose of cheap money into the global economy. Suddenly, borrowing was practically free. Companies loaded up on debt, buying back their own stock, artificially inflating prices. Real estate became a rocket ship, up 50%, 100%, even 200% in some markets. The S&P 500 soared over 400% from its 2009 low. If you just owned assets, stocks, crypto, houses, you felt like a genius. But here's the kicker. This wasn't normal. It was an unprecedented experiment, and like all experiments, it had a shelf life. For years, economists debated if inflation would ever return. Then, 2020 happened. Supply chains fractured, consumer demand exploded, and governments poured trillions into the economy. Suddenly, inflation wasn't a theoretical risk. It was a roaring beast. Gas prices surged past $5 a gallon. Groceries became luxury items, and rents skyrocketed. Central banks, who had been our sweet prince of easy money, were forced to become the executioners. They slammed the brakes, hiking interest rates at the fastest pace in decades. From near zero, we shot up past 5%. This wasn't just about borrowing money. It was a full-scale assault on the very foundation of the easy money era. The prince was dead. Long live. What exactly? The sweet prince era rewarded passive investing. Now, you need to be active. First, cash is king again. High-yield savings accounts and short-term T-bills are offering 5% or more, virtually risk-free. That's a game changer. Second, reevaluate your debt. High-interest credit card debt or adjustable-rate mortgages are now ticking time bombs. Prioritize paying them down. Third, focus on companies with strong balance sheets and consistent cash flow, not just growth potential. Dividend stocks, value plays, and quality bonds are back in vogue. If you're finding this valuable and want to stay ahead of these seismic shifts, hit that subscribe button right now. Don't get left behind in this new financial landscape. But there's one critical mistake almost everyone is still making. The biggest mistake? Assuming the old rules still apply. Many are still chasing meme stocks or high-growth tech without understanding the cost of capital has exploded. This isn't just a blip. It's a structural change. Companies relying on cheap debt to fuel growth are vulnerable. Your ultimate defense? Diversification beyond just stocks and bonds. Look at real assets, commodities, even alternative investments that thrive in inflationary environments. Consider tactical asset allocation, actively shifting your investments based on market conditions, not just blindly holding. Education is your shield. Understand interest rate cycles, inflation's impact, and how to spot genuine value. The Sweet Prince gave us a free ride. Now, you have to earn it, but the opportunities for those who adapt are immense. If you're finding this valuable and want to stay ahead of these seismic shifts, hit that subscribe button right now. Don't get left behind in this new financial landscape. The era of the Sweet Prince, of easy, cheap money, is officially over. We've saluted its passing, but now it's time to adapt. Don't be the investor who pines for yesterday. Embrace the new rules, protect your wealth, and position yourself for growth in this challenging, yet opportunistic, new financial kingdom. Subscribe for more insights that will keep you ahead of the curve.